Friends, welcome to another episode of Fin Pathshala. This time we will go into assets in the balance sheet in a little more detail than what we did last time. I would like you to go through the corporate balance sheets of a few companies that I believe are interesting. This is from an Indian background. Let me share with you the snippets or the extracts of some of the good balance sheets I thought which might be useful for us. I picked up 4 companies the way we did in the earlier liability company discussion, and I have picked up the same 4 companies. Reliance Industries, which is among the largest Indian companies in India, maybe the largest. Avenue Supermarts, which is in retail. GMR, which is in infrastructure, it runs airports, power plants and roads. And Mahindra Finance, which is an NBFC or a non-banking financial corporation that actually lends money. So the total assets, let's go to Reliance first. Of Reliance, consolidated financials are 1166,000 crores. I've kept the denomination in thousands of crores so that we are talking about smaller numbers, and smaller numbers are always easy to understand. I've broken down the assets into 3, which is typically the way you will find in corporate balance sheets. Fixed assets, and fixed assets are those which are long-term assets to begin with. And they typically comprise of items like land, building, plant, machinery. Intangible assets could be computer software, could be brands and patents, and in some cases licenses. We pay for licenses. For example, to operate an airport, maybe if you need a license, or to operate a radio station, you need a license. Those are all fixed assets, both long-term and both tangible and intangible. Other non-current assets are other long-term assets. Typically, you might find that there is long-term investments in many of them. For example, if you invest into a strategic partnership or a joint venture company, that's a long-term investment. And you might even find an item called deferred taxes sometimes, which we will discuss in some other video because it's slightly complicated. And then you have current assets. Current assets are typically your trade receivables you have sold to customers and you have not yet got paid for it, or your inventories which are produced or bought, raw materials or work in process, packing materials, etc. There might be some short-term advances that you might have given to vendors, some short-term loans given, some cash and bank balances. These are your typical current assets. So if you look at the Reliance company, 632 crore are fixed assets. That means long-term tangible and intangible assets. How much do they constitute as a percentage of the total assets? 54% is coming from fixed assets in the case of Reliance. What is the story when it comes to Avenue Supermarts? 52%. So they are also, now Avenue Supermarts, many of us will know, they actually own their stores, and that's why the fixed assets are very high. 42% of GMR, meaning airports and power plants, are coming from fixed assets, whereas in the case of Mahindra Finance, it's only 1%, just 1%. Look at the contrast. What about the other non-current assets? 24% in Reliance, 29% in Avenue Supermarts, 31% in GMR, and 1% in Mahindra Finance. Again, look at the contrast. And what are the current liabilities? Current assets, 22% in Reliance, 19% in Avenue Supermarts, 27% in Mahindra Finance, and as much as 98% in Mahindra Finance and 27% in GMR. That's the breakup of the composition, friends, of your assets. It might be good, I suggest, if you can, try and look at other retail companies. Do they have similar breakup of fixed assets and other non-current assets and current assets, or is it different from Avenue Supermarts? That might be a good case study for your further understanding. But in the case of Mahindra Finance, you will find that all the loans, or almost all of them, are current. Here we have to understand that the meaning of current, or the definition of current in an NBFC, might be slightly different from that of a company which is manufacturing or trading or running airports. The loans that are given would be more likely classified as current in the sense of operational. So current should also be understood as operational assets and assets that will tend to churn by definition. Churn means keep moving, keep moving. So in Mahindra Finance, what is likely to happen is loans are likely to keep getting repaid. So that means they get moving, even if some of them extend beyond 1 year. So even if, let us say, Mahindra Finance gives a loan for 3 years to somebody, even that 3-year loan is classified as current because their operating cycle is really more than 1 year. So 12 months is a nice threshold, but may not be applicable in the case of a company like Mahindra Finance. Thank you very much, friends, for a patient listening. Look forward to interacting with you in other videos. Thank you very much.